Hi there, Etoro. It is Monday, the 24th of January, and that means it's time to take a look at what moved the markets last week. Starting with this bloody red screen. So this is the 1 week performance of the S&P 500, and you can see that there weren't many places to hide over the past week. The thing moving the market continues to be the same narrative that's been going on since Q3, Q4 of last year, but has accelerated into this year. And that is the economic conditions that the stock market, that companies in the stock market are operating in, are changing. So the central banks around the world are thinking about or are already tightening their economic policies. However, there are a few other things at play now. Before we get into those, I just wanted to look at some information regarding the various indices and other assets that we should be watching. So what you can see on the screen are three indices. The candles represent the NASDAQ composite. So that's the big brother to the NASDAQ 100. The yellow line is the NASDAQ 100, and the purple line on screen is the S&P 500. Now you can see that the NASDAQ composite is down nearly 13% since the year began. The NASDAQ 100 hasn't fared much better. It is a smaller index comprised of the biggest companies in the NASDAQ composite. So it's been slightly less volatile, but not by that much actually. And the S&P 500 has fared a little bit better, but is still down, I think, over 8% for the year. So not a good start to the year, particularly since January is statistically one of the better months of the year. Something that's quite interesting to look at in times of turmoil is the bond market. Now, bond traders tend to be more sophisticated, more experienced types of investors. They can be financial institutions, governments, but they tend to not be individuals. And because of the sophistication and the experience of these types of investors, it's largely thought that the bond market sometimes predicts what will happen in the wider market. Now, the US 10-year Treasury yields are quoted quite often, and we can see that there was an enormous rally from the beginning of the year through to roughly a week ago, an increase of nearly 23% in terms of the yield. There's an inverse relationship between bond yields and certain types of stocks, particularly technology stocks, because an increase in yields signals that the cost of debt is going to be increasing at some point in time. So any companies that are debt hungry, they're going to have to pay more if they want to take on additional debt, or the cost of servicing the current debt could increase depending on the type of agreement. So this rally in of itself isn't that interesting. We knew it was going on. We knew how it affects technology stocks. But what is interesting is that, 5 sessions ago, the bond yield started rolling over, and not by a little bit either. As with all things in the stock market, the bull markets are typically overdone, and the pullbacks and corrections are typically overdone too. This is signaling that bond traders and bond investors think that this rally was overdone and have now been getting out of those positions. The takeaway here is that the bond market might be the early signal telling us the sell-off in equities is overdone and the market is going to turn. Another interesting data point that I keep track of is the relative performance of growth stocks in the S&P 500 to value stocks. Now, actually, I've got two ETFs here. I've got one represents the value stocks in the S&P 500, and the other ETF represents the growth stocks in the S&P 500. Both of these ETFs are pretty enormously down for the year. The S&P 500 is down 8% for the year overall. But that doesn't tell me what's happening within the S&P 500. However, if I plot the chart of value stocks over growth stocks, then I can see the relative performance of value stocks has been an upward movement of 10%. So value stocks have lost less through the sell-off through this year. Again, this is something that we probably had an awareness of, but it's always good to confirm it by looking at the data. Another piece of anecdotal data in this case, and something I did share last week, is the irony that people are the most bearish at the time where they should be probably buying the most, and vice versa. People are the most bullish when they probably should be hedging the most. The chart that I have on screen, which is low resolution, I apologize for that, shows the proportion of bears in the market at various price points for the S&P 500. So you can see that when the S&P 500 has experienced its largest drops, the bears are out in full force. People are the most bearish at the deepest point of the drop. This is probably most obvious with the sell-off in March 2020, although people remained bearish because they couldn't believe that the S&P 500 could rally so strongly out of those lockdowns. Now, once again, we are seeing elevated bearish behavior in the market. The number of bears in the market is increasing quite rapidly. Is this the highest point? We'll only know once the data is there, so looking backwards. But we can see that as the drop has continued, the number of bears has increased. So this is one of the contrarian indicators that I tend to look at. People always behave the same way. So one of the other major things that move the market, I did mention this 2 weeks ago, is Netflix posted earnings, and earnings weren't that bad, but the stock dropped massively, 25% in a single session after having dropped through the 3 weeks preceding the earnings report. The reason for the drop is that Netflix has said, listen, we don't think we're going to grow as fast as we have historically, and investors really don't like the sound of that. It also seems as though margins might come under pressure. So Netflix, if we look at it, some of the stats, we can see it's a company that's growing revenue quite nicely, it's growing profit quite nicely. It's just that the market doesn't like the news that it's not growing as fast as it had historically, which is impossible, to be fair. All companies slow down eventually. They have been increasing their margins quite nicely through the past few years. And I think the other reason that investors had sold off is that these margins might come under pressure. In order to find more growth, Netflix is going to have to source more subscribers from other countries. And in order to get subscribers from those various countries, they're going to have to make content local to those people to draw them in. Not everyone speaks English, and not everyone likes to watch US television. However, it is important to keep some perspective. So here on screen, I have Netflix's PE ratio for the past 15 or so years. What we can see is that the PE ratio for the business is at the lowest that it has been, or tied lowest, more or less, over the past 10 years. So historically speaking, Netflix is the cheapest, if we were to just look at the PE ratio, that it has been for over the past 10 years. Now, I'm sure the bears would argue that the company is likely to experience multiple compression. So the PE ratio is probably going to be permanently lower for a while, especially if economic policy is tightening and the company's growth is slowing. And I don't disagree, but I still think that this is a very interesting data point. Additionally, if we look at the enterprise value over EBITDA, the data here doesn't go as far back as the data that I just showed, but we can see that that multiple, although high, because Netflix is a growth company, even if growth is slowing, that multiple is the lowest that it's been over this 4-year period, which includes the very wonky period that all stocks went through in 2018. So jumping back to this chart, Netflix had one hell of a week and day on Friday, but any company that was even vaguely a peer or a competitor of Netflix, so for example, Disney with Disney Plus, Discovery, Amazon with Amazon Prime, got hammered to shit on Friday. Now, I'm not sure that's exactly fair. We'll have to see what comes out of the earnings for those specific companies. But I had thought that Netflix might have experienced something of a slowdown, whereas the likes of Disney, whose stock has been hammered for a lot longer than Netflix, is probably going to come out of earnings quite nicely. All right, the other big ticket item that's been going on through the past week, longer than the past week, but seems to be coming to a head, is the Ukraine conflict. So with every day that passes, it looks a little bit more likely that there's going to be a war. And this means that the countries that are involved in the war are going to call on those countries that they consider allies. And that means a lot of political pressure on a number of countries that are directly or indirectly involved in this. At the moment, there's a lot of posturing going on, but also there's some very definite action being taken now. And so this is becoming quite concerning for the people of Ukraine. But this will also have an effect on the wider stock market if a war were to actually kick off. I'm not sure how the particular countries involved might respond, especially because the world is currently at war with coronavirus and lockdowns. There's very high inflation. There are lots of people out of work. There are lots of companies that are on the edge of folding. So how does the world deal with battling coronavirus as well as trying to fight an actual war? I don't know. So this does feel like a car crash in slow motion, but we're just going to have to see. Hopefully the parties involved back down, but we'll see. I mentioned last week that the central governments around the world are increasing their rates as a way to combat inflation, but also that I don't think that their policies have been the biggest driver of inflation. And actually, I think it's supply chains that have been the biggest issue. Now, there are signs that supply chains are beginning to heal and shipping costs are starting to come down, but that doesn't mean the problem is by any means fixed. So I've highlighted some text here. Before the pandemic, the highest ever reading of the index, which researchers had computed back to the 1990s, was April 2011. So the troubles associated with an earthquake and tsunami in Japan pushed that index up to 1.7 standard deviations. But by last year, October, it reached 4.4. So even though supply chains might be healing, shipping costs coming down, they might stay at fairly elevated levels for a while or not. So this is part of the debate that I'm seeing being debated amongst various economists at the moment. So will the recovery be sharp and short, or will it be protracted and we just need to live with this for another few years? The positive thing to take away from this is that the combination of increasing rates within countries combined with the supply chains healing, even if they don't heal as quickly as we would like, means that we'll see inflation coming down fairly soon. There are various data sources you can look at if you are interested, so to determine things like the cost of shipping around the world, shipping times, the number of ships parked outside of ports, etc. But one commonly cited index is the Baltic Exchange Dry Index. So this is an index that provides a benchmark for the prices of moving raw materials by sea. And what we can tell here, I've zoomed out a little bit, is that the current price is more or less in line with the historic average. And this was after running all the way up to nearly 6,000 in October of last year. So a pretty sharp drop in these prices. Now, if the same thing were to happen across supply chains all around the world, we might see inflation drop off a lot more sharply than many are expecting. And that makes me wonder what central banks might do about their economic policies. This article published by the Financial Times is quite interesting. It talks about many different facets when it comes to the sell-off last week. So last week was a week for the records. So if you do have a subscription, I invite you to read the article. But what I found particularly interesting is another contrarian indicator. So investors have been increasing the number of put contracts that they have on the SPY. You will notice that towards the beginning of 2020, there was a fairly large blip. And I'm guessing this was probably in the depths of the drop in March 2020. And now we're seeing an enormous number of put contracts on the SPY. Now, the contrarian investor might say when such a large portion of investors are betting that the market is going to be bearish, it's probably going to be going the other way fairly soon. So once again, there is blood in the streets, but people aren't buying, they're selling. Interesting, isn't it? Human behavior never changes. All right, what about this week? So this week and next week are going to be pivotal in terms of earnings information. You can see there are some enormous companies that are going to report this week, bellwethers of their various industries, Amex, Microsoft, McDonald's, Apple, Tesla, etc. And then through next week, similarly big names, Amazon, Facebook, Alibaba, Black & Decker, etc., etc. Now on Friday, we saw how the market reacts when a big popular company doesn't do as well as they would like. So I would think that the next 2 weeks could be quite volatile depending on the results that we get from these companies. All right, so in addition to all of the madness that's going on in the world right now, this week is also quite an important week for investors. Many people are waiting for the Fed to give their statement, and they will be analyzing every word, every sentence, every turn of phrase to try and figure out if the Fed is turning more optimistic or pessimistic, dovish or hawkish. We'll also see an interest rate decision. People are expecting the rate to be increased in March, so any deviation from that could send the market one way or the other. There's some other macro data coming out, but by far that meeting will be the one that's most watched and will have the greatest ability to move the market. All right, and that's it for last week and forward looking through this week. I know that it has been quite a hectic ride through January and last week in particular. Drawdowns of 10% in the NASDAQ Composite and NASDAQ 100 aren't very common, but they aren't very rare either. For those of you that had the gut-wrenching experience that was the market in March 2020, you'll know that in the depths of the sell-in, it does not feel great. But then when you look back a month or two, you wish that you had held the positions that you had, or even added more to those positions, because these types of things present incredible opportunity. I know a number of people will be nervous, frustrated, and panicking about the price action at the moment, but it will pass. It always has, and it always will. The only thing that's going to stop the stock market growing and global GDP growing is some kind of planet-destroying cataclysm. And if that happens, you're not going to care about Netflix stock being down. You're going to want to make sure you know how to make fire by rubbing two sticks together. All right, I'll speak to you next week. Goodbye.